Good afternoon, ladies and gents, and welcome to LAT's weekly market insights. It is Friday the 24th of February, come to the end of another trading week here, and all focus sat here on Friday shifted towards the PCE data, which was due out at 1:30 this afternoon out of the US. Again, it is the Federal Reserve's current preferred metric for inflation, and it has been a miss on expectation. Okay, the figures coming out here for the year-over-year figures at 4.7% and 0.6% for the month-over-month, and that is up from 0.3 expected and 4.3% respectively expected. Now that miss on inflation, of course, pushes the rhetoric of a more hawkish Federal Reserve and the possibility of a 50 basis point hike in March getting closer and closer. Now pre-PCE, it was priced at around 20% expectation for a 50% basis point, with 25 still firmly the front runner. Currently at the moment, as we sit here, we're not long off after this data, only around an hour after this data. We're now sat at 25% possibility of a 50 basis point hike, and that hawkish tone has filtered down through the markets. We're seeing a risk-off mood at the moment. Okay, in the bond market, equities and the dollar, we're seeing a very, very highly correlated move here. Just coming across the charts, we can see the S&P here, S&P futures, the E-mini futures here, moving aggressively lower, coming back down through the 4,000 handle, breaking the lows of the week, which were printed at 39.76. Euro dollar here as well, of course, that's sort of preferred measure for the dollar, also moving lower, beautiful trends down. So that flight to safety, dollar strength off the back of a more hawkish Fed, also sending euro dollar here back down through 106. Again, seeing that safe haven move. And then the bond markets, the correlation still persisting here. So we are seeing bonds down in line with equities, lower here at the moment, and the yields. Also, this is just looking at the 10-year bonds, the US 10-year T-notes here. The yields also moving higher, just showing that risk-off sentiment at the moment. Of course, the big question, in these bond markets, it's become a superb trading opportunity for us, trading the bond itself, trading the 10-year bonds, playing this very simplistic correlation at the moment. And of course, the bond's always seen as that front runner for overall sentiment and gauge for the overall sort of risk on, risk off. Are we hawkish, dovish? Where do we see the Federal Reserve's interest rates going next? And it'd be good just to have a look at this correlation and talk a little bit about the bond market and why we are seeing this unfold. We did this with our students here at the Academy this week. We started looking at the bond markets and looking towards how they were influencing it and how they were such a great guide of what was happening with future interest rates. And we're just going to quickly have a walk down, a run through what that looks like. The rationale for that. Okay, so if we are looking towards here, we're looking at government bonds. Okay, in this instance, we're looking at the 10-year bonds. Okay, the T-notes. Okay, the 10-year bonds in the US, seen as one of sort of the benchmark bonds, one of the more significant bond markets to have a look at that between the 2-year and the 10-year bonds. Now these bonds are split into numerous elements. Okay, there's probably 5 key elements in total which we need to consider when we're talking about the bond markets. The first of those is the auction value. Yeah, when those bonds come to market, what are they going to be worth? Okay, it's the par value. Okay, par value. What are those bonds going to be worth when they come to market? They of course go to auction with a previous coupon, and then they're auctioned off. We see what is the coupon, what is the potential returns on that bond. The higher interest rates are at the time, the higher that bond is going to be. So par value, for instance, may be £1,000. Okay, you've then got the coupon. The coupon is what is the return on that bond. Okay, and that is fixed, right? That is set in stone. At the moment, they're around 3.6, 3.7%. Different, of course, for different bonds. But that's going to be fixed for the duration of that bond. So in this instance, it is 4% you are going to get per year for 10 years. Okay, it is a 10-year bond, of course. Okay, so that 4%, you are going to be getting your £40. Okay, £40 per year for the 10 years. Okay, so you've got the par value of that bond, you've got the coupon of that bond, you then have the yield. Now the yield is always an inverse correlation to the value of that bond. Okay, when we are looking, when we're looking at the yield, we're always taking the coupon and we are dividing it by the current market value. Okay, now that's in the secondary market. Okay, it's constantly changing the value of that bond according to what's happening in the market, what's happening in the world, what's the overall sentiment economically at the moment, and that secondary market will constantly fluctuate. Okay, now we divide those times it by 100 to generate our yield. Okay, now if therefore the value of that bond decreases, the yield on that bond will increase. Okay, so if, for instance, the current market value for that bond came from £1,000 down to £700, you are going to see an inverse correlation when you divide the coupon by 700 and times that. Suddenly, you're going to see an increase in the yield. Okay, yields will be rising to 4.5%, 5.5%, whatever it might be. Okay, so that yield constantly adjusting, and that's what markets are focusing on all the time. What are the current yields, and therefore what is the expected future interest rates from the Federal Reserve? Okay, and with a rise in interest rates, you would expect to see a rise in the coupon that's being offered when these bonds come to auction. So when we see that rise in the coupon, it's representing the current sentiment and current thought process for future rates, future interest rates coming out of the Fed. Okay, we also then have the current market value. Okay, this is what's of course constantly fluctuating. It's going to adjust, it's going to change according to the sentiment. And there's a few things that will drive this. Okay, it will be interest rates themselves, probably the biggest hitter for that. If the Fed start to raise rates, if it becomes more likely of a 50 basis point hike in the future, you will also see, you'll then see bond values decreasing, but the coupons, the primary bond market, when they come to auction, the coupons being offered will naturally be higher off the back of that to go in line with those interest rates. Okay, you've also got duration risk. Okay, duration risk, if you are holding a 3-month bond, okay, it's a very safe bond, it's government backed, it's very unlikely that it's quite easy to predict what the economic conditions are going to be within the US in 3 months' time. Very difficult to do that for over a 30-year period. Okay, so duration risk, if you are in a longer term bond, you would expect to be paid out more on that bond because you are taking a risk on the fact that you don't know where that bond's going to be valued at, or what the current economic and stability of the nation is going to be in 30 years. Okay, of course, some of the more credit-worthy nations, your Germanys and the US's, it's quite safe still over 30 years, you would suspect, but that's of course not the case the world over. Okay, so with that in mind, you then have creditworthiness. Creditworthiness. Yeah. You have, of course, rating agencies. Okay, you have Moody's, Fitch. Okay, they give a credit rating to a nation, to a company, to a government. Okay, going anywhere from sort of a AAA rating to a C rating, whatever it might be, according to the level of confidence, I guess, around that. Now, somewhere like we said, the Germanys, the US's of the world have a very high credit rating, and therefore very secure, and therefore deemed as particularly low risk. Okay, that's going to fluctuate, of course, with time. Okay, and what is happening currently in the markets. Okay, if you take the extreme scenario here at the moment of a Russia and Ukraine, the tension that's brewing there, or it's not brewing, it's boiled over there now, creates not only duration risk but also creditworthy risk. Yeah, it's very difficult to say where those nations are going to be. Okay, now a lot of this then falls into central bank policy. Okay, massively important. What do the Fed do next? That's what we're trying to weigh up all the way through. And importantly, of course, inflation also a huge factor for current market value, and that's what we are seeing today. This PCE measure is a measure of inflation. Okay, and that inflation today much higher than perhaps we thought it was going to be, and therefore hence why we have seen such a dramatic reaction, that hawkish tone, pushing the Fed closer to a 50 basis point hike. And that 50 basis point hike, even if it doesn't come through, the fear of that in the market is enough to ultimately send these markets lower. Now, why does that then change the value of the bond? Okay, if you have got new bonds coming to auction, which come to auction each week, the bonds that are coming to auction are going to be offered with a higher coupon. They might be saying, okay, well, I think rates are going to be at 4.5%, and therefore the coupon goes up on that bond. The bonds that you are sat on with a 4% coupon all of a sudden now become less desirable. You're going to get a lower return than the new bonds being auctioned, and therefore to make them more valuable, those bonds are devalued. The value of that bond is devalued. You are competing against a bond coming to market that has a much higher coupon. Again, as you go to compete with that, therefore then drives the value, the current market value down. Okay, so the level of competitiveness in the market right now, markets are pricing a rise in interest rates, therefore they are now pricing a rise in coupons that are going to be offered with these bonds, and therefore the current bonds in the market are now worth less. Hence why this top right here, the T-notes, the 10-year bonds, we're now seeing aggressively selling off. Now the inverse of that, of course, current market value decreasing, therefore the yields increasing. So here the 10-year yield chart beneath, and we can see just having an upward move at the moment. And this trend has been in place now for a considerable period of time. Okay, it's been a beautiful uptrend, this little turnaround, the lovely inverse head and shoulders down on the yield chart here. Beautiful inverse head and shoulders, which broke out back on the 4th of February. And ever since then, this has just trended aggressively higher, influencing that risk sentiment. Okay, now interestingly, we saw the yield chart turn around and start moving nicely higher, quite a long way really before the S&P. Okay, the S&P in the top left here, on the 4th of February, yes, we saw a sell-off, but really we ranged. Okay, there really wasn't too much emphasis, quite reasonable, some strong sell-offs, but we stayed somewhat within a range from 40.80 to 41.80, just below that 4200 handle. But the yields were consistently rising, suggesting, there is a pricing here of higher rates, and now we're starting finally, to see from the 16th, 17th, we're starting to see now this strong sell-off and a bit more of a capitulation here in the equity space. Okay, the bond markets, of course, also demonstrating that a long way ahead of the S&P. So positioning of S&P around the 4160, these highs, this resistance back up here, 4170, 4180, very, very comfortable trades to be short in S&P, certainly when you start to compare the correlations then with what the yields are doing. For that early warning sign, the bond market's providing that early warning of what could potentially happen next. So very interesting space at the moment, big correlation. So we've got the par value, we've got the coupon, the yield, the current market value, and then last but not least, this sort of final element to consider is then the maturity on that bond. Okay, they can range anywhere from a month up to okay, actually, I think they're actually offering 100-year bonds at the moment, but generally speaking, we'll go up to 30-year bonds. Okay, so you've got 3 months, 6 month, 12 month, 2-year, 5s, 10s, 30s, and so on and so forth. Now, maturity, of course, then influencing the return on that bond. Okay, and that maturity risk, duration risk here we talked about, and the current market value playing then into the maturity and the expected yields. Generally speaking, a normal yield curve, you would get a higher yield on a longer dated bond, and on the front end, you would get a lower yield. Yeah, it is on that simple basis, but it is easier to predict what is going to be going on in 3 months' time than it is in 30 years' time. Okay, so this is what we're seeing at the moment. It's been beautiful watching it unfold. Okay, and it's come to fruition today. Okay, we are most definitely in a hawkish mood this afternoon, following on from that inflation print. Equities moving lower, the dollar strengthening, the safe haven plays unfolding, the bond markets, perfect correlation with the index, the yields, that beautiful inverse correlation with the bond that we can see here, and the perfect thing about this was it was the yields and the bonds which led the way back at the start of February to tell us, be careful, markets are pricing rate hikes. This is not as positive. Is this a question? Big question was it a bear market rally? Certainly that's looking the case here at the moment. Okay, interesting to see here. I've just come out to a much higher time frame, just on the weekly, on a weekly chart here on the S&P 500. For me, I've been a long-term bear in this, so it's quite nice to see this roll over now. But the major downtrend with these lower highs, lower lows, still for now remains intact, provided we stay below this lower high at the sort of 4400 handle. there's still a downtrend and certainly the possibility for more downside in this to come. Okay, these inflation prints are only supporting that at the moment. Okay, so bond markets here, an interesting look, fantastic correlations at the moment. The PCE figures providing the catalyst to see this move lower, but the yields and the bonds providing the early insight we needed to try and capitalize on some of these short positions that are unfolding to close out this week. Okay, that's all from us then for this week. An interesting look, hopefully, at the bond markets. The main driving forces behind those bonds. Certainly our students here at LAT this week have been trading heavily, looking at these as perfect opportunities. Hopefully you have too at home. Please do join us next week for another weekly market insights. Thanks everybody. Bye for now.